Hi there, this is Alvin from Dr. Wealth. Welcome back to another episode. Today, the topic would be about Manulife US REIT. And I also want to share why I would personally avoid some of these REITs, even though the yields are very lucrative, very attractive, and more than 10% dividend yield at the point of recording. And I want to share beyond just Manulife US REIT, and there are some other REITs that I think they are in the same category and they're facing the same risk that Manulife US REIT is undergoing as well. So let's start off with Manulife REIT. What happened was that last week they announced a 10% valuation drop, given that the economic environment is not going to be good, it's slowing down, interest rate is going up, and that hurts the REIT's performance, and that's why the valuation went down. But a 10% drop in valuation is very hefty for a REIT itself, and it has a lot of repercussion. And one of the repercussion is this debt to asset, or we call it gearing ratio. It has gone up to 49%. And how does this work out? Why does valuation drop requires this debt as gearing to go up? The reason is because the debt to asset, the debt is the numerator, asset is the denominator. So when the asset value, which is the valuation of the properties that Manulife REIT have, and they decline, right? So the denominator goes lower, and assuming the numerator doesn't change, the gearing ratio goes up. So to really understand how does this cascading effect takes place, I want to introduce you to this REIT's vicious cycle, and this is what I think Manulife US REIT is being trapped into at this point in time. It is not like it is really their problem, okay? It's more like it's a macroeconomic situation or environment. Of course, yes, we can say that they could have reacted faster, but of course, in hindsight, everything is clearer, right? So let us now take some time to explain this vicious cycle for REITs. And it's not just for Manulife REIT, okay? It's applicable for all the REITs out there. They have a virtuous cycle and then there's a vicious cycle. Okay, so let's talk about the vicious cycle right now. And we start off from the economic slowdown and the high interest rate somewhere in the middle of the chart. Okay, you can see there. We all know that the economy is slowing, right? Because interest rate has been going up, and that slows down the economy, and people are talking about in 2023 there might be a recession coming, and personally I do think there is a recession that's coming. So economic slowdown this year is very likely. So when economy slow down, company will hire less, they will have less workers, they may even retrench workers, and that's why the demand for office space would go down, and that leads to lower occupancy for this kind of REIT, because Manulife US REIT is an grade A office REIT. So they have leased out all these properties to many of the big corporations, mainly in the finance sector, right? So with that, lower occupancy will bring about lower rent, and lower rent will bring about lower dividends for the unit holders. And on the interest rate side, it's also a fact, as REITs are geared instruments, so which means that they borrow money to buy those properties, right? They are always in debt. It's just how much the debt is of a question. So when the interest expense goes up, the financing charges goes up, that means that there will be less profit to share with the unit holders, so which means the distribution also goes down. You can see there's double whammy macroeconomic factors that's affecting REITs, not just Manulife REIT, but in general, right? But just that for Manulife REIT, it got hit a lot more because they have another additional problem, which I will highlight to you later. So when they have lower distribution, naturally the REIT prices will go down. And also because of a higher interest rate, right, the bonds are also yielding higher, investors will demand a higher dividend yield from REITs, which are deemed as riskier. So that's why for the dividend yield of these REITs to go up, the prices have to come down, right? So they have this effect that's going on right now. And lower distribution would also lead to lower valuations, okay? Because the valuation of the properties, one of it is to project how much rental it is going to receive based on these properties that Manulife REIT have. So if the distribution goes down, likely the valuation has also gone down. Okay, that's what happened, right? 10% drop in the valuation for Manulife REIT. And with the valuation drop, we already discussed that it leads to higher gearing. And what's the problem with this higher gearing? Because at 49%, the issue is that it has very little debt room left, because the legal limit in Singapore is 50%. Okay, because Manulife US REIT is listed in Singapore, so it's compliant to Singapore rules. And just that 1% is very risky, because what if the valuation drop further, right? That would cause the gearing ratio to shoot past that 50% requirement mark. And this 50% requirement mark is even a temporary limit, because the Monetary Authority of Singapore has increased this limit from 45% to 50% during the COVID period. They have yet to reduce back to 45%, and that is still a possibility. If that happens, that means Manulife US REIT have already passed that limit already. So when this gearing limit has been surpassed, they have to bring it lower to comply with the requirements. And even if they're still within this 50% gearing limit, the issue is that they will not be able to borrow more money given this climate, right? Because they have little debt room left, and without the ability to raise money, they will be unable to grow further, unable to buy more properties and grow the portfolio. So the other part of it is that with lower REIT prices, it's also difficult for the Manulife US REIT to raise equity funding, which means rights issue from the current unit holders, because the share price, if it's way below the book value, at this point in time it's about 0.4 times of the book value, that shows that the share price is significantly undervalued. And if the rights issue continues and proceeds, the price that they issue will be really very low below the book value of the US properties. So in a nutshell, it is very difficult for Manulife US REIT to raise money, whether by equity or is it by debt funding. So the ability to grow the portfolio in the near future is almost impossible, right? The more crucial issue is that they need to really resolve the debt that they have. They're trying to bring down the gearing, right? That's number one, and also trying to bring up the rental income on the other side of the house, right? So it has to get out of this cycle. Otherwise, this cycle will continue and the REIT prices will continue to fall. So that is the issue that Manulife REIT is facing right now. And we can see that this is the performance of the share price. This is from the inception since IPO. The share price have dropped 60%. For a REIT, usually people are expecting a lot more stability. That shows you how macroeconomic environment can really harm or benefit a REIT. So since COVID, the share price have actually never recovered. It has actually gone lower than below the COVID low in March 2020. And I think that it will continue to stay low unless they get out of the vicious cycle that I mentioned just now. And that's another big problem that Manulife US REIT has to face, that is outside of the macroeconomic factors. Okay, this is more of the changing consumer preferences that is with regards to US Grade A office. We all know that during pandemic, a lot of people started to work from home, and those people who can work in a Grade A office are those that are likely to be able to work from home. So post-COVID period, the workers also stop going back to office because they're very used to working from home. So based on the US Census Bureau, the number of people working from home actually tripled since before the COVID period. And that caused the occupancy rate to get hit, right? So the occupancy in 3Q 2019 was 97.3% for Manulife REIT, and then the latest quarter it was 88.1%. So you can see almost a 10% drop. So this seems like it's a permanent trend, and being a Grade A office focused REIT, it got hit probably the most. And that's why they wanted to do something different, right? They talk about this hotelized office where they don't just have the regular office to lease out big spaces to big corporation. They also want to lease out to like shared office to smaller corporation, SMEs, individuals, solopreneurs, okay, that kind of WeWork kind of concept, right? And they have facilities within the building itself too. If you ask me, I think this is a very competitive space, right? Even talking about shared office, I'm not sure how much they can pull it off and increase the rental that way, right? So hopefully this plan work, but I'm not very optimistic due to the competition that's already available in the market right now. So if they have to reduce the debt, there are only two significant solutions that they can decide on. These both solutions are not going to be smooth sailing as well. It's not going to be beneficial for the unit holders too. So let me explain why. First is that they can decide to sell some of the properties in their portfolio, right? So when they sell the properties, they can repay the mortgage loan, and that reduces the gearing. But given that their share prices are so low and the market is weak, the sentiment is weak, the demand for these properties is not high to begin with, right? So if you want to sell now, means that you have to sell at fire sale prices, and that's also not beneficial to unit holders because you'll be selling way below the book value or the valuation of properties. And second is that they can do a rights issue, which means raise money from the existing unit holders, but we covered that just now during the vicious cycle, right? Because when they want to do an equity fundraising, likely the share price that they offer has to be lower than the prevailing share price trading in the market. The rights price in itself will be also heavily discounted, and that further dilutes the share price. We can see that either solution is going to be painful for unit holders, and the worst is that they might need to do both in order to really bring down the gearing ratio, because right now it's really very close to the limit and they need to do something about it. So I believe that rights issue essentially will be pending, and unit holders need to be prepared for it, right? Because it's going to be issued at a very deep discount to the valuation of the properties. So that's why I do think that it's really not worth the risk investing in these REITs at this point in time, even though their dividend yield are like more than 10%. And lastly, we want to look at what are potentially other REITs that may suffer in the same fate as with Manulife US REIT. So I pick up 3 of them because they are exposed in the same macroeconomic environment as Manulife US REIT. This is the closest replication of what Manulife US REIT is. Okay, they are also grade A office, and the occupancy has also fallen below 90% right now, and the gearing is 38.7%, even though it doesn't look as high as Manulife REIT. But don't forget, they haven't really done the valuation recently, so we don't know, right, whether it will suffer a similar 10% drop, and if so, then that is something that to be concerned of as well. And 2 is Keppel Pacific Oak US REIT. Same thing, is US office REIT, just that it has a bit more differences compared to Prime or Manulife, in the sense that it mainly serve the tech companies, right? They are closer to all those tech hubs, but these properties may not have high demand as well, because we all know that tech companies are also firing staff and less workers, and likewise demand is likely to fall, right? Occupancy is slightly higher, 92.5%, as compared to the other 2 REITs, but again, we don't know whether once the lease ends will they renew. And the gearing is at 37.5%, which is equivalent, which is comparable to Prime US REIT. Same thing, its valuation drop, the gearing will shoot up. And lastly is ARA US Hospitality REIT, which is a hotel REIT, okay? And occupancy is 65.4%, which don't really recover the pre-COVID kind of numbers, right? It's still quite slow in its recovery, so that's a bit disappointing in that sense. And the gearing is also on 39.3%, higher side among the rest, right? So if again valuation drop, this gearing is going to go up as well. So these are some potential minefields that I think investors should watch out for, right? So if you really want to invest in these high yielding REITs, do take note that you probably got to do more due diligence to really flag out all the risks and decide for yourself whether is it worth it. But for me, at this moment, I definitely would not want to invest in them, because I do think that the risks are not fully priced in yet, and I think there might be more further downsides from where we are right now. So I hope you get to learn a lot from this video, and please remember to give me a thumbs up and subscribe to the channel so that you will see me in the next episode. Goodbye.